Right, today I'm going to tell you about endowments. You probably haven't heard of them if you're like 20 plus, because back in my day when we did mortgages, we had an endowment policy or we had a repayment mortgage. The endowment policy was for interest-only mortgages and you were using an investment-backed vehicle to repay your mortgage. Endowments were slammed in the past, but guess what? They are making a comeback. They just won't allow them for mortgages because the banks, profit-making businesses, I'll call them that because that's the politest way of putting it, front load the interest. So that payment that you're making is a lot of interest and a teeny weeny bit of capital. But when you're doing interest only, you pay just the interest due on the loan amount. And then you accumulate money to pay the loan back. And that's what an endowment was. So anyway, what I'm going to tell you about is a unit linked endowment policy. You can have it with profits. You can have unit linked. Let's talk unit linked. Here, stocks and shares, bonds, and property funds. And you can use an endowment policy for income or growth, whichever way you want to do it. And the growth will have a compounding accelerator, which means the profit that you make will then be reinvested and it will compound and it will grow faster at 11%, actually, when I say faster, because 11%, simple Google will tell you that's the average growth that you get out of a long-term endowment policy. You can take them for 5 years, you can take them for 25 years. Depends on what your purpose is. Could be university fees, could be for a deposit on a house, could be for retirement, couldn't it? Could be a pension, couldn't it? And pensions aren't far away from being endowment policies. They're just called something different. Bit like our politicians, wrapped in a different name, but exactly the same underneath. Want to see the full story? The full version is out on my YouTube now.